Happy Tuesday, everybody. I hope you had a great long weekend. After the weeks we're having in the news cycle, not to mention the markets, it's nice to get some rest from it all. Yes, I know there's almost as much going on during the days when the markets are closed as when they're open, but here we go. Today is February 18th, 2025, and this is your Tuesday market update. I want to begin with a quote from the Chief Investment Officer of Capital Group. That's the parent company of the American Funds family of mutual funds. He notes this week that, quote, periods of market volatility are inevitable, but not permanent. Close quote. So I think it's interesting. So as we talk about volatility on these market update videos, please keep in mind, markets are pretty much batting 1,000 in the recovery department. What I mean by this is that over any short or even some intermediate periods in the markets, the volatility has been hard to deal with. But over the long term, as evidenced by the proximity to market right now to highs, here in the United States and actually some international markets as well, we've seen markets recover from bouts of volatility over and over again. Is it really different this time? That's one of the most debated comments in the investment arena. I'd say as much as things change, they seem to stay the same. So with that, I remind you that this market update meeting is one of the two meetings that you have with me every week. The other one, the Friday planning video, is more about that long term and the goals and plans that come along with it. Please keep your eye on the prize. As this past Friday's video spoke about, it may be best to leave the Fast and Furious to the movies. Let's review last week's market action and let's preview the short week ahead. The markets started the week on a positive note last Monday, rebounding from the prior week's modest declines. Investors largely shrugged off weekend tariff threats from President Trump, choosing instead to focus on economic fundamentals. Stocks gapped higher at the open in stark contrast to the previous 2 Mondays, which had started with steep declines. Inflation remains a key concern following last Friday's University of Michigan consumer sentiment report, which showed a sharp spike in the one-year inflation expectations. However, relief came in the form of New York Fed's consumer survey, which showed stable 1-year and 3-year inflation expectations, easing investors' fears. Markets initially pulled back around midday as long-term inflation expectations ticked up from, however, key technical support levels held firm, allowing the markets to recover in the afternoon. Investors positioned themselves ahead of Fed Chair Jerome Powell's upcoming congressional testimony and Wednesday's key inflation data. That's that CPI report coming. The Dow closed up 1/3 of 1%, S&P up 2/3 of 1%, the NASDAQ up over 3/4 of 1%. Markets traded sideways on Tuesday, recovering from early losses tied to a follow-up announcement from President Trump concerning new tariffs on steel and aluminum. Equities gapped lower at the open as the renewed tariff rhetoric caused a brief sell-off. However, the S&P 500 found support around that 60-50 level, a key technical point that has become a magnet in recent trading. Bond yields ticked higher earlier in the day, which pressured stocks, but those losses were reversed as Powell began speaking on Capitol Hill. While Powell's remarks were not dovish, let's make sure we're clear on that, they were also not more hawkish than feared, and his optimistic economic outlook did help markets recover. There we go again, not as bad as feared. Recall that term? I'm still not sure where that goes in the list. Good, bad list. Where on the list? The market's attention turned towards Wednesday's CPI release, with investors hesitant to make large moves ahead of the crucial inflation information. The Dow was up 1/4 of 1%, S&P virtually flat on the day, just very slight tilt to the positive, and the NASDAQ up over 1/2 of 1%. Wednesday had markets reacting negatively to hotter than expected inflation data, which reignited concerns that the Federal Reserve may have to delay their rate cuts. The CPI for January showed inflation at 3% year over year, above the expectation of 2.9%. Core CPI, which excludes food and energy, came in at 3.3, also above expectations. 10-year Treasury yield surged in response, reflecting shifting market expectations that the Fed may not cut rates until late 2025 instead of mid-year, which is what the markets are looking at. Stocks gapped lower at the open as traders reacted to the inflation data, with all major indices hitting new lows for the week. Markets staged a partial recovery later in the session following reports that Russia and Ukraine might be making progress towards peace talks. This geopolitical optimism helped to limit losses. Markets still closed in the red. Dow down 1/2 of 1%, S&P down just over 1/4 of 1%, and the NASDAQ down almost 1/4 of 1%. Markets surged higher on Thursday, reversing early losses after a better than feared PPI report and softer than expected tariff announcements from President Trump. As we got to the other big eco data for the week, the producer price index, it came in slightly hotter than expected at 3.5% versus 3.2%. However, investors saw some of the inflationary pressures as transitory. Remember that word? Whoa. With key contributors being high energy prices due to winter storms and record egg prices from an avian flu outbreak. Please take note. There are only so many inputs in the PPI and the CPI for that matter, and the PCE, which is coming soon. The more we parse out certain contributors, the more muddy the water gets. Soon, again, please note, we will begin to hear some of the outlier economists say that these no longer accurately measure the economy. Change the units of measure and it becomes easier to move the goalposts. Not totally stuck in the old eco data. There is some, I think, that's stale, but it is a slippery slope to start debunking eco data that has helped to direct monetary and fiscal policy for decades. That's all I'm saying about that. Markets opened lower as investors initially reacted to the inflation data, but stocks rebounded sharply as bond yields fell, signaling the PPI data wasn't as worrisome as initially thought. The big catalyst for the rebound was President Trump's tariff announcement. While reciprocal tariffs were on foreign goods were expected, Trump confirmed they wouldn't take effect immediately, easing fears on the imminent trade war. Market had priced in immediate trade disruptions, so the delay provided a little bit of relief and sent stocks higher. The S&P surged above that 6,100 level by the close, marked only the third time in history it's finished above this key psychological threshold. The Dow up 0.75%, S&P up just over 1%, and the Nasdaq up a bit over 0.5%. Stocks started to take a breather on Friday as they opened little change. A bunch of data, none of it more than noise, was hitting the tape. One of the big reports, not so much noise, retail sales. And though if you cared to pay attention, it was a bit disturbing. But like so much of the rest, change the units of measure or move the goalposts. This is one that worried me. Valentine's Day historically returns for the S&P per Ryan Dietrich was only down 7 times in all of Valentine's sessions. We'll hear about that in just a second, how we ended up. UBS pointed out maybe the obvious, maybe not, that tariffs would boost inflation and provide a headwind for equities. Even as earnings dig on the Mag 7 and the idea that the spread between the earnings growth from the 7 and the remaining 493 is shrinking, you had that too. By the end of the day, markets did not all finish in the red, but the Dow was down about 1/3 of 1%, S&P unchanged, but on the slight negative side of that, and the lone green of the bunch, the Nasdaq, was up just under 0.5%. Even with all that, all three closed in the green for the week. The Dow was up 0.5%, S&P up 1.5%, the Nasdaq was up 2.5%. With that, let's dig into this short week ahead. Of course, you know by now the markets here in the U.S. were closed yesterday in honor of Washington's birthday, the first president, of course, not the location. We have Fed, we have earnings, and we even have a little bit of eco data to come. For the Fed, we'll get minutes from the January meeting on Wednesday, and during the week, we'll get Fed heads all week long. Harker, Bowman, Waller, Daly, Barr, Jefferson, Goolsbee, Musalem, and Kugler. Please remember, with focus back on this crew, they're going to be floating some ideas to see how the markets react. Watch for those. For earnings, most have come and gone. As we've discussed, they haven't been so bad. We will get Walmart and Alibaba, and even a product launch from Apple is expected. Add in the eco data from manufacturing. I think it will tariffs. Think about when it comes to manufacturing. Will tariffs help to reshore manufacturing to the U.S. shores? We'll have to see. Housing and, of course, the labor market. All of this to fuel the markets to know which direction the Fed is leaning and what will happen next. So as we go into this short market week, again, one without a Monday in it, I love to say that, I still say keep your head about you and listen to the signal, not the noise. I do think the Fast and Furious is slowing down a bit, but regardless, it's important to keep everything in its place. Please keep your focus on the long-term goals. The short-term moves will often breed opportunity, but that depends on each of you and your individual goals. Please come back on Friday as we get another time for a short meeting, this time to talk about some planning. Have a great week.